Today, I'm going to rank some of the best tax strategies I use with my clients who have retired or retired early, because I want to help you understand what sort of tax strategies give you the best bang for your buck. That way you don't waste your time, or even worse, ignore these and be in a position where you are so patriotic that you're giving Uncle Sam hundreds of thousands of dollars in tips over your lifetime. But you first need to understand how I'm ranking these tax strategies, because there are thousands of tax strategies you'll find online. But without knowing how they apply to your specific goal of retirement, you could be wasting your time or being in a position where you're letting the tax tail wag the dog. And what I mean by that is that some people get so focused on saving taxes in the short run that they end up jeopardizing what truly matters. It's kind of like tunnel vision. And my goal is to break these down from the perspective of a certified financial planner like myself. And these are the type of strategies I help people with on a daily basis. And I want to help you avoid some of the mistakes. So we got the tier list right here. I'm going to go through this list one by one, ranking them from S to F. S having the biggest bang for your buck and F being a little bit smaller of a bang for your buck. These are all great strategies, and some will be better or worse depending on your situation. But overall, I'm going to rank them based on tax savings today, how easy it is to implement, and then overall the long-term benefit. And this will help you understand how to rank it for yourself. That way you are optimizing what truly matters. Now let's dive into the first strategy that everyone that wants to retire early, I'd say between the ages of 45 to 65, really need to understand if they own a taxable brokerage account. Now, have you ever been invested in an asset when the stock market went down? I'd say most of you, the answer is yes. You've probably owned stocks in the last 4 years. And typically most people will just wait it out. So imagine you own a stock in your taxable brokerage account and it goes up in value and it hits a high point. But like a lot of stocks do during a correction, it drops and hits a new low. You then get a statement and you might be worried, thinking, hey, what's going on in here? But just because a stock drops doesn't mean it's a bad company or a bad fund. It could just be very short-lived, actually. What you could do is just wait it out and do nothing. But what if you're able to benefit from that drop? For example, let's say that you have a stock where it was valued at $100. And what you do when the stock market drops is sell it at $50 while it's at the bottom. Wait, isn't that the opposite of what you want to do? Selling stock when the market drops? Well, in this scenario, when you sell it, you recognize a $50 loss. And the good news is that you can write it off on your taxes. But we don't want to miss when this stock does decide to rebound, because sometimes that can happen pretty fast. So what we do is we buy something that is similar, not identical, but something that is $50. So with a little proactive tax strategy, you still own the stock recovers back to $100, but now you get to save $50. Now, during the sell-off in 2020, when markets dropped, we were actually able to take advantage of this for our clients before the markets rallied. So by the end of the year, the stock market had recovered and the values are back up. So we have clients at that point who have gained money in their accounts, but we also have tax losses that they were to write off. So this first strategy, tax loss harvesting, is great, but you need to have a rules-based system to follow to make sure you are monitoring it, not missing out on this. For example, having tolerance bands on your investments so you know when to do this is a great idea. Now, I rank this as more of a bottom tier strategy for getting the best bang for your buck. So overall, this is an F. Now, an F in school is pretty bad. I don't mean this as an F in school. I'm just using this grading scale. So it's an F, not because it's bad, because I think there are more effective strategies that we'll talk about. So yes, it can save you some tax today if you have some unrealized losses. It can be relatively easy to implement if you know the rules like wash sales and have a rebalancing strategy in place. But the reason why this is ranked last is because there are limitations on how losses can be used to offset taxable income. Capital losses, which are losses from the sale of stock, are first used to offset capital gains. And they can offset any amount of capital gains. But once you run out of capital gains, capital losses can only use to offset about $3,000 of non-capital gain income, things like wages or rental income or business income, just to name a few. And any additional capital losses are carried forward into future years, either offset future capital gains or to be used with that same $3,000 at a time. So there are certainly tax savings to be had here, but they are in more of a limited way. But at the end of the day, higher after-tax wealth is the end goal, not simply tax loss harvesting because the market is down. This is more of a, hey, let's make lemonade when life gives you lemons type of strategy. But next, let's talk about the long lost cousin of tax loss harvesting. Well, not lost, but you'll understand when I explain this. Sometimes I'll have a client where I actually want to purposely recognize capital gain income, meaning Even though this is appreciated, we sell it even though we don't need this money. This is the process of purposely recognizing a capital gain, selling a taxable asset when it's most advantageous to you. For example, you can realize capital gains potentially at a 0% tax rate. That's going to increase your cost basis, which is a good thing. So imagine you retired early and you're living off a brokerage account, dividends and interest, and you're living your best life. And let's say, hypothetically, you need to create $80,000 per year in income for you and your wife. Now, let's say you need to realize about $40,000 in capital gains, and the rest is going to be made up of interest and dividends. For this example, let's say that puts your AGI, your adjusted gross income, at $60,000. And the good news is that because of that preferential treatment, you're going to pay $0 in federal taxes. Because if we scroll down here to the capital gains brackets, that's going to be either 0, 15, or 20% as far as a tax rate. And at this level of income, we're at $0. But you can see there's actually some room here where we can actually realize even more capital gains and still pay $0 in taxes, which gives you a higher cost basis for the future. And it can help you overall long-term investment strategy, for example, if you need to rebalance. And guess what? You can optimize and take this into the max and still pay $0 in taxes. This is called gains harvesting. You're doing the opposite of tax loss harvesting. But here's what most people miss when they retire early. Even though you pay $0 in taxes, your health insurance premiums, which for many of you will be based off of marketplace insurance, is going to be affected not by your taxable income, but what called your modified adjusted gross income. And the key is that for those of you that want to retire early and you read about tax gain harvesting and you decide to do this, this can be the difference between paying $300 per month in premiums versus $900 per month in premiums, because capital gains count towards your modified adjusted gross income. So you're in a position now where your medical costs essentially triple. So many people miss that tax gain harvesting when you retire early might mean you lose a little bit of your health insurance subsidies. So again, tax gain harvesting, I'm going to put this at an E on the tier list in terms of bang for your buck. And the reason why is because there's a good amount of opportunity doing this, especially if your portfolio is a little bit maybe out of whack or you need a remodel. And as far as the tax savings today, there's an immediate benefit as in it's going to increase your cost basis right away, but it could be a little bit more complex to implement because you have to watch out for all those different tax torpedoes that might affect your taxes and your insurance premiums, making sure you also have a plan for reinvesting that stock. But overall, the long-term benefit can help you manage capital gains. So it's really hard to rank this super high because of how niche this might be for many folks compared to some of the other strategies we're going to talk about. So again, great strategy, but could be an S tier for some of you because everyone's different. But nonetheless, let's move on to our next strategy. But if you haven't been paying attention lately to the tax code, the death tax, the estate tax, is going to affect a lot more people than it used to. So in 2024, the estate tax unified credit amount is $13.6 million per individual, or around $27 million per married couple, which means essentially that if you die and you have less than $27 million, none of your estate will be subject to estate taxes. However, this exemption in the credit amount only applies until the end of 2025, when the law that increased the estate tax exemption, the Tax Cuts and Jobs Act, is scheduled to sunset and revert back to the higher personal tax rates as well as estate taxes. And this is going to bring the exemption amount down to around $6 to $8 million per person in 2026, of course, adjusted for inflation, which means a lot more people will be now hit with a 40% tax on your estate to your survivors or heirs. For example, if you, God forbid, you pass away and you have an estate worth $20 million, under the current law, your estate would owe no federal estate taxes. But if the exemption drops to $6 million per person, your estate could be taxed on $8 million. Again, $20 million minus $12 million exemption for a married couple, and results in a potential tax bill of around $3.2 million. And that's a substantial amount of your hard-earned wealth being wasted away to your to taxes instead of your heirs. Versus for some people, if they put together something like the right trust, or they start to give money out of their estate and take advantage of the current law, it could potentially save you millions of dollars in taxes. So overall, I give this strategy a D. This will give you a big bang for your buck if you're very wealthy, you have a big estate. As far as tax savings today, it's going to be really dependent on what happens next year. As far as implementation, gifting away, right now in 2024, you can gift $18,000 without filing a gift tax return. That's pretty easy to do, but it's gonna be very complex to implement all these sort of trust strategies. So you'd want to talk with an attorney on this. And while the long-term benefits can potentially be substantial, especially if you have a large estate, the overall effectiveness of the strategy is going to be really dependent on the future law change. The upcoming expiration of the Tax Cuts and Jobs Act in 2026 may or may not expire. So this adds another level of uncertainty as far as the estate tax exemption, or this could change, which affects a lot of the long-term benefits of this type of planning. That leads to the next strategy on the list. And for most of you that want to retire early, which means you need to potentially liquidate some investments at some point because living off the interest just isn't enough, this is going to really matter to you. But the thing is, different types of investments generate different types of income, such as capital gains, dividends, and interest. And each type of income is subject to potentially different tax rates, right? For example, we have interest from income on bonds is typically taxed on your ordinary rate, while long-term capital gains and qualified dividends are taxed at the preferential rates. And every time you sell an investment in a taxable brokerage account, you run the risk of incurring a tax bill. And the more often you trade, the greater the tax toll can be, especially to those in those higher brackets who are subject to high taxes on both the short and long-term capital gains. For example, with this chart, it's showing the growth of $100,000 over a 30-year period, even with just 5% turnover, meaning selling investments that trigger a taxable event. And as you go to the right on this chart, tax rates are higher, and it's going to have a much bigger impact on your returns because investors in higher tax brackets face more significant tax drag because their short-term and long-term gains are taxed at higher rates. So overall, if you can minimize turnover and have a tax-efficient investment strategy, it can significantly impact the growth of your investment portfolio. If you have higher turnover with your investments or the investment funds you use are also high turnover, higher tax rates can drastically reduce the value of your investments, especially over such a long period of time. So overall, I give this strategy a C on the tier list, and it's starting to get higher here. And it could really mean thousands of extra dollars saved over a long period of time. And while it doesn't immediately provide any sort of significant tax savings up front, tax drag is something that can really wither away at your investments over time if you don't pay attention to it. It's not really overly complex to implement, but it does require regular monitoring and adjustments to make sure it aligns with your goals. And that also means having access to investment tools, which can be straightforward for some, but pretty daunting for others. But overall, as far as the long-term benefits of a well thought out asset allocation strategy, this can be quite substantial. So getting this right is critical. But simply focusing on investment allocation alone means missing out on the opportunity to maximize total portfolio tax efficiency. Now, there are generally 3 ways you can invest your money. And your goal before you reach retirement should be to fill up as much of these 3 buckets that I'm showing you right here as much as you can. We've got the tax-free bucket, taxable, and then the tax-deferred bucket. Now, tax-free is you get taxed now, but then it can grow and compound and never get taxed again. You have the taxable, which is more like a leaky bucket where you're sort of taxed on the way in bits and pieces, whether it's dividends or interest or capital gains. And then you have the tax deferred bucket where you're going to be taxed at some point in the future. Now, historically, we're at one of the lowest federal tax rates in history, even though I know a lot of people, it may not feel like it. So ask yourself, where do you think taxes will be in the future? And most importantly, where will taxes be when you retire? Imagine a scenario where you retire and all your money is in those tax deferred buckets. Now, that's not the end of the world. You got a tax deduction by contributing, but what's going to happen is that your standard of living, the way you want to live in your retirement, is going to be driven by your tax rate. When you want to spend more money, you're going to be paying a lot more in taxes, which essentially means you have a little bit less control on your tax rate. Your goal when you get to retirement is to be in a position where you can better control your tax rates. Say you needed $60,000 for income, but it's taxed, just hypothetically in the future at 50%. That means if you pull out $60,000, you're only going to get half of that. So this is where asset location comes in, where you think ahead and you have not just diversification with your investments, but also diversification with your accounts. So you can pull some from your tax deferred account and then pull the rest from maybe a taxable account or a tax-free account. And at that point, you have a lot more flexibility as far as creating any sort of tax-efficient income. So implementing the appropriate asset allocation and asset location strategies is key to successful portfolio management. Asset location helps create a tax-efficient portfolio by placing each dollar in a meaningful tax now, tax later, or tax never investment bucket. So as far as tax savings now, you're less likely to get tax savings up front. And while not overly complex, as far as implementing it, it does require a little bit of knowledge and effort compared to asset allocation, which many people know about. However, once you set it up, it can be pretty straightforward as far as maintaining it. And it can definitely give you a good long-term bang for your buck. The best example is if you need a big lump sum out of your portfolio one day, say in the future for some big medical expense, you might get crushed in taxes if all your money is coming from that tax deferred account. So again, having that extra layer of flexibility, if you have time to make up for it, is exactly what asset location does for you. But let's continue to take this further and move to the last 2 strategies, because you can have a diversified portfolio and a diversified asset location, but you could be leaving hundreds of thousands of dollars in taxes saved on the table. So many people that come to me, they want to retire early. There's a period early on where they say, hey Matt, I'm ready to retire and I have asset location in place, I have a brokerage account, I have some Roth and also tax deferred. And a lot of times their tax projection might look a little bit of something like this. This is something that I call the retirement tax valley, where very little taxes is paid early on because they are letting their accounts grow tax deferred. But even though that might make you feel all warm and fuzzy inside, it could cost you because you see this ramp up later on in life because some of you have large 401ks and IRAs, and the government is not so patiently waiting to take anywhere from 30 to 40% in taxes because of required minimum distributions. So how do we get around this? This is where Roth conversions can potentially save you hundreds of thousands of dollars in taxes over the long run. And what you do is you strategically convert small amounts of Roth over a long period of time. And the advantage is that once your money is converted to Roth, although you pay taxes up front, it's never taxed again and it goes tax-free. And guess what? Roth IRAs do not have forced distributions, unlike your IRAs and 401ks. So overall, I give Roth conversions an A on the scale. They have the ability to give you a huge bang for your buck and really better control your taxes over the long run. They obviously don't make sense for everyone, but oftentimes we can find a lot of value, a lot of benefit from them. They are pretty straightforward, but there are some nuances as far as how do you actually pay the taxes on the conversion. I prefer paying them with your brokerage account, or if you have cash on the side, or if you don't have cash, you can withhold taxes, but that's just not quite as optimal because you're not getting as much in the Roth. But definitely, please do not withhold taxes if you're under the age of 59.5, because that means you're gonna have to pay penalties because IRS actually considers that tax withholding to be an early withdrawal. So you need to find that Roth conversion sweet spot for you, meaning what tax rate is most optimal for you to target to hit the most optimal amount of a conversion, factoring in health insurance costs, of course, your goals. But overall, this can be a great long-term strategy, especially considering our government being trillions of dollars in debt. I mean, how do you think they're gonna get out of that debt? Probably increasing taxes. But we haven't covered everything quite yet, because one of the most important of all these tax strategies for early retirement is the next thing I'm going to talk about. And I can honestly say that this is going to matter most for 95% of the people that want to retire early out there. So everyone that comes to me have all types of investment accounts. They have different expectations for how long they think they'll live. Maybe they're single, married, or have a bunch of kids. And there really is no cookie cutter way to withdraw money from your account. Well, there is. It's called the 4% rule, and I don't have time right now to get into all the details and my qualms with that. But this is perhaps one of the biggest things people miss, and that is taking money from the wrong accounts at the wrong time. For example, many people think that the rule of thumb of going taxable, then tax deferred, then tax-free is automatically going to be the best strategy for them. But let me show you how this might be a huge mistake. For example, this is the case for someone who has large tax deferred accounts and they keep kicking the can down the road until RMD age. And they're only focused on minimizing taxes in the short term. They might be in a situation where if they go with their current strategy of just going taxable, tax deferred, and then tax free, they might be in a situation where they're paying over $2 million more in taxes than they need to, versus just doing some small Roth conversions up to the 12% bracket. And instead they're going to leave the IRS a tip. But the key is everyone is different. Some people, they come to me and I say, hey, you should actually do more of a pro rata approach based on your circumstance, where you're taking equally from both the taxable and tax deferred to optimize your tax situation. And I've had others come to me and say, hey, guess what? I converted everything and now I have all this tax-free money, and have to break the news and tell them, hey, you actually would have been a lot better off if you really did nothing, because you would have been actually in a 10 to 12% bracket throughout your retirement, and that really wouldn't have changed much, and instead you decide to convert everything at such a high tax bracket. So you take this too far and don't know the long-term impact, it can really work against you. Because having a withdrawal strategy that goes above and beyond the 4% rule and above and beyond the traditional rules of thumb can mean lower health insurance costs, more net income to you, and of course also paying less in taxes over your lifetime. So overall, this is why I consider having an overall withdrawal strategy that is unique to you as one of the top tax strategies over the long run, because it's like compounding. If you have something that isn't very tax efficient, such as a bad withdrawal strategy, and you continue with it for decades without realizing it, that's where it can really eat away at the value of your investments over time. So overall, a strategy like this can mean immediate tax optimization that can result in significant tax savings right away. And while it requires a little bit more careful planning and possibly bringing in a professional, the implementation of this withdrawal strategy is pretty manageable for most individuals, as long as you pay attention to things like the tax code, understanding the implications of different accounts, and also coordinating withdrawals with your other income sources. So for that reason, withdrawal strategy that is unique to you for your situation can truly give you the biggest bang for your buck when you retire early. So again, in my opinion, these early retirement tax strategies give you the biggest bang for your buck. And now you know how you can put it all together for yourself and really put more money in your pocket, avoid some of these mistakes, and you understand how and whether you should apply this to your situation. Because tax planning, although sometimes can be dry and boring for some people, I seriously don't know why I enjoy it so much, have the power to help you have the best possible retirement without letting Uncle Sam ruin all the fun. But there's one thing having a tax smart withdrawal strategy, but if you save a bunch in taxes and still run out of money, I do not consider that a win. And there are also ones I don't quite feel apply to an early retirement. And this is so important to get right so you don't end up outliving your assets. So I made a video breaking down some of the best withdrawal strategies, and I go through one that we use for our clients. You can go ahead and watch that by clicking right here. Again, this is Matt Calcagno. I'm a certified financial planner over here at 1 Degree Advisors. If you'd like to talk to me or someone on my team about your financial plan, you can click the link in the description and we'd love to chat with you. Thanks for watching, and I'll catch you guys in the next one.